Here's the honest truth about two of the most debated investing strategies on the planet. By the end of this video, you'll know exactly which one wins, backed by decades of data, not opinion. And the answer might surprise you because it's not what most financial influencers will tell you. So grab something to drink and let's settle this once and for all. Here's the setup. You've got a chunk of money, let's say $30,000, and you want to invest it for the long haul. You could dump it all in tomorrow. That's called a lump sum. Or you could spread it out over 12 months, investing $2,500 each month. That's dollar cost averaging. Which approach wins? The data has an answer, and it's more nuanced than you'll hear almost anywhere else. Let's start with what the numbers actually say. Vanguard ran one of the most comprehensive studies on this topic, analyzing market data across multiple decades. Their conclusion? Lump sum investing outperforms dollar cost averaging roughly 2/3 of the time. 2 out of every 3 scenarios. That's a significant edge right out of the gate. Here's why that makes sense on paper. Markets trend upward over time. The S&P 500, for example, has returned about 10% annually on average since its inception. When you hold cash back, you're essentially betting that prices will be lower in the future. And historically, they're usually not. You're leaving money on the table for every day that cash sits uninvested. Now, here's where it gets interesting and where most videos stop, because raw returns aren't the whole story. The second point is where the research reveals something most people never consider. It's not just about what strategy makes more money. It's about what strategy you'll actually stick with. The Dalbar Institute has been studying investor behavior since the 1990s. Their findings are brutal. The average equity fund investor earned roughly 3% less per year than the funds they were invested in. Every single year for decades. The funds did fine. The people in those funds did not. Why? Because humans are wired to buy high and sell low. Markets crash, panic, everyone sells. Markets recover, FOMO kicks in. People chase the rally at the top. Dollar cost averaging doesn't just reduce regret. It reduces the opportunity to make catastrophically bad decisions in moments of fear. Think about it this way. If you dump $30,000 into the market tomorrow and it drops 30% next month, how do you feel? Probably terrible. Maybe you panic. Maybe you sell at the bottom. But if you invested over 12 months and the market crashed in month 3, you'd be buying at those same lower prices with fresh money. Your regret gets compressed. Your emotional exposure shrinks. A 2014 study from the University of Cambridge found something similar. Investors who used systematic, regular contributions showed significantly lower rates of portfolio abandonment during market downturns. They stayed invested. And staying invested is the only thing that actually matters in the long run. So here's the trade-off laid bare. Lump sum wins on pure expected returns. Most of the time. Dollar cost averaging wins on behavioral insurance. Almost all of the time. Now, if this is clicking for you, hit that subscribe button. I break down financial research like this every single week, and the next part is where it gets really interesting. Because the third thing I want to share is something the investment industry almost never discusses openly. It's not about choosing one strategy. It's about understanding which one actually fits your specific situation. Here's the thing most people miss. The Vanguard study that gave lump sum its 2/3 advantage. It was comparing all cash deployed immediately versus all cash deployed over 12 months. That's a full year of market exposure you're giving up with traditional DCA. But what if you compress that window? Enter the modified approach, sometimes called rapid dollar cost averaging or simply front-loaded DCA. Instead of spreading investments over 12 months, you deploy over 3 to 6 months, weekly or bi-weekly contributions. This captures most of lump sum's return advantage while still giving you the behavioral benefits of dollar cost averaging. A 2023 analysis from the Journal of Financial Planning looked at this exact question. They found that a 6-month DCA window narrowed lump sum's advantage from roughly 2% annually down to less than 0.5%. And in many market conditions, the difference was statistically insignificant. Meanwhile, investors using this approach showed measurably lower stress levels and higher contribution consistency compared to lump sum investors. Let that sink in for a second. The gap you're fighting over between lump sum and DCA shrinks dramatically when you tighten the DCA window. The real enemy isn't the strategy you choose. It's the behavioral mistakes that come from choosing a strategy you can't psychologically handle. Here's what that means for you in practice. If you have $30,000, a stable income, and genuine emotional resilience, lump sum is probably fine. You'll win more often than not. But if that money came from selling a house, an inheritance, or a business exit, if it's more than you're used to having at risk, consider the modified approach. 3 to 6 months, steady contributions, lower regret, minimal return drag. There's one more layer worth adding: tax efficiency. When you invest a lump sum all at once, your entire position starts accumulating taxable gains immediately. With DCA, those gains are staggered. In tax advantaged accounts like IRAs or 401k plans, this doesn't matter. But in taxable brokerage accounts, the timing of when gains are recognized can have real implications for your tax bill down the road. This is especially relevant in volatile markets where you might trigger short term capital gains taxes if you're selling and rebuying frequently, a risk that's naturally mitigated when you're contributing on a set schedule rather than making one time decisions. So, where does that leave us? The headlines say lump sum wins. That's technically true, most of the time by a small margin. But headlines don't measure what matters most for actual people. They don't account for the investor who panics and sells, the one who freezes and never invests because the lump sum feels too scary, the one who waits for a dip that never comes and keeps waiting. Dollar cost averaging, especially a modified 3 to 6 month version, doesn't just reduce regret. It creates the conditions for you to actually stay in the game. And in investing, staying in the game is everything. The best strategy isn't the one with the highest expected return on a spreadsheet. It's the one you'll actually follow through on when things get uncomfortable. That's the data backed answer. That's what the research says when you look at the whole picture. If you found this useful, share it with someone who's debating lump sum versus DCA right now. And subscribe. I've got more breakdowns of financial research coming, including one on the most counterintuitive retirement finding I've come across in years. You'll want to see that one. See you in the next video.